everybody got so impatient and tempestuous that because the recession didn't show up in 2023, therefore it's not going to show up at all. And it reminds me a lot of what happened in 2007 when the recession everybody expected to start didn't start till December of that year. And then, of course, the NBER didn't date the recession until the end of 2008. People were surprised that it actually started at the end of 07, but the lags were much longer back then because even after the Fed aggressively raised interest rates from 04 to 06, that was a 2-year cycle, a magnitude about the same as we have right now. But, people kept on tapping into the housing bubble and extracting home equity out of their inflated home price and cash out refinancing. So that kept the Energizer Bunny going. And I didn't waver at the time, although it took longer for things to play out. And so this time around, last year, we had 3% real GDP growth. Well, let's boil it down. What happened last year? Even though we had sub 4% unemployment for the first time ever in that sort of labor market, the government allowed the deficit to balloon 25%. Never happened before. We had tremendous fiscal stimulus. On top of that, we had double-digit credit card growth. And then layer on top of that, the last chapter of the excess savings file from the personal sector being put to work in terms of consumer spending. And if you really adjust for those three, what I call non-recurring events, there was no growth in the economy last year. And people will say, well, Rosenberg, you're data mining. And I'm saying, no, I'd actually prefer to call it analysis. Because these things are not recurring. The San Francisco Fed just put out a report saying that more than 100% of the $2 trillion of stimulus checks in 2021 that kept the Energizer Bunny still marching, that's over. And the fiscal stimulus, the extent of that, the deficit is not going up 25% this year. Incrementally, fiscal policy is not adding to growth. And now we're seeing with credit card default rates at their highest level in 12 years, you're starting to see the lenders cutting back on limits on credit cards and cutting back on credit card extension. And actually in April, and that's what I said in my report before the data came out, is, what does it mean that credit card outstanding hardly ever goes down in the United States? The narcissistic consumer actually paid down their expensive credit card debt in April. And I was saying, is that sort of a leading indicator? It proved to be, looking at the May retail sales numbers today, not just that, but the downward revisions. So that's what we're looking at. We're looking at all the stuff that supported the economy last year is gone. But what's staring us in the face is the lagged impact of the damage the Fed's already done on interest rates, because the economy resets to interest rates in both directions, mind you, with long lags. And then there are things that can get in the way of the recession call, like I talked about in 2007, the ongoing extraction of home equity kept the expansion going until it ended, because all expansions end and all recessions end. It's all just part of the cycle. So where I'm different, I suppose, from almost every other economist on the planet is I do not believe in fairy tales. I don't believe that the business cycle has been repealed. And I firmly believe that in a hugely credit-driven economy like the United States, interest rates matter, but they hit the economy with lags. So this is going to be the story going forward, especially because there are no other real antidotes to put a floor under the thing. I actually think that the consumer recession that a lot of us, including me, were thinking we're going to start last year, well, I got news for you. Delayed is not derailed, okay? So you can be early and wrong, or just plain wrong. And I guess I was early and wrong, but I was viewed as being early and wrong back in 2007 before being proven to be spectacularly right in 2008. And I'm not trying to compare the two cycles. We're not going to have a 30% meltdown in home prices and Armageddon in the financial sector. However, the business cycle is the business cycle. Life moves in cycles. Seasonal patterns move in cycles. And the markets and the economy move in cycles. And so we're actually right now, I think we're at a tipping point. And I think it's a wide array of data are really suggesting that the economy is starting to tip over into a classic NBER recession. And when I talk about this to people, it's incredible. It's like they've never seen a recession in their life. It's like I look them in their eyes and I'm saying, your kid is ugly. No, it's actually just a matter of being prepared for the really inevitable recession, which will then be followed by the inevitable expansion. It's just the business cycle. The housing data have turned lower. You're seeing the industry in building materials, that's rolled over. You're starting to see some cracks emerge even in the fun and game in area of cyclical consumer services. Look at what happened to airfares in the CPI number last week. It looks as though that demand for air travel is starting to recede, admittedly from very high levels, but we're talking about growth here. We're not talking about levels. It was actually rather surprising today to see the weakness in restaurants in the retail sales data. So we're starting to see, even in the areas, part of the reopening trade, part of what people were spending their cash from the stimulus checks on, because of course we choked ourselves on Peloton bikes and patio furniture and redecorating the living room, when we couldn't get out of the house and COVID was raging. And now it's been all about fun and game services, the YOLO spending, you only live once, the experience spending, that's starting to show signs of fatigue. I was struck, honest to God, last week to listen to Jay Powell, I guess he is really the chief economic cheerleader for the United States, and everybody just laughs it up. Now, one reporter said, as Powell is up at the podium saying those two words, that the economy is solid and is strong, was so diametrically opposed to the tone of the beige book, the Fed's beige book, which actually called the pace of economic activity slight and modest, which is not necessarily a recession, but that's usually what you get in the transition towards a recession, those two words. The beige book is what? The beige book is not data. Every 6 weeks, the Fed sends its staff into the field to interview business contacts across every industry, in every region. And they've done it for 60 years. And the tone of the beige book, the reason why I was below consensus on retail sales is because I looked at the commentary on retail sales. And I said, there's no way that we're getting a 0.5 on core control, or we're getting a 0.3 or 0.4 in headline. That's not going to happen. Well, it didn't happen. And people say to me, how'd you get the number right? It's because I read the beige book, which is actually, doesn't get revised. It's actually facts on the ground. They've done the beige book for 60 years. And I felt I would put up my hand if I was there. I would put up my hand, at the press scrum. And I'd say, Mr. Powell, why does the Fed expend all the time and the resources on the beige book every 6 weeks when you don't even listen to it? They're so hyped up about inflation because they're living in a world in the rearview mirror. They're fighting yesterday's battle. We had the inflation. Had it gone from 9 to around 3% inflation, had a couple of bumps in the road this year because of auto insurance premiums. It has nothing to do with Fed policy or the economy. It was just a lagged response to the horrible claims experience that the property and casualty insurance industry faced. They fattened their margins, and now that story is over. We saw that in the CPI number. And yet you read the beige book, and all you read about is a rapid diminishment in corporate pricing power. And it's forward-looking. The Fed, what does the Fed talk about? The Fed not just talks about that strong and solid economy, which was last year's story. They're still harping about the lack of confidence they have on the disinflation, even though we've gone from 9 there for 1 month down to 3+, and all the pressures are heading lower in the future. But they don't talk about the pressures in the future on inflation. They don't talk about that. They talk about the year-over-year percent change in the CPI and the core CPI, which are inherently lagging indicators. And they focus way too much on contemporaneous and lagging indicators. That's a big problem. And when people say to me, are you nervous about the recession? Yeah, well, I guess I'm not nervous about it. I think it really could have been avoided. But the Fed has stayed too tight for too long. And I know people will say, well, but what about the stock market? Really? The stock market? 3 stocks? You're serious, right? They talk about financial conditions. Oh, all the economists you must interview. Financial conditions are so easy. Well, the easy financial conditions are not producing an accelerating economy. These loose, quotes, financial conditions are actually just accelerating on below trend, which is creating all the conditions for disinflation, which was front in the Fed meeting. And so, that's what I'm talking about here, that the Fed, and maybe they were just so shamed by transitory and missing the 18-month inflation bulge, they still feel somehow their credibility's been jeopardized. Once burned, twice shy, but the sacrificial lamb is going to be the economy, and we're starting to see it in real time. And it wasn't just beginning today, because the retail sales number in April was even worse, post-revision was even worse. And you have back-to-back quarters now of negative real retail sales. That's 40% of the consumer, and really a heavily cyclical part of consumer spending, because it doesn't have healthcare, it doesn't have education, it doesn't have telecom. There's some segments, wide swaths of consumer spending that just never go down, no matter how bad things are. But the importance of the retail sales is that it's very, very cyclical in nature, and it's giving you a very important signal right now.